Hello, everyone. Welcome to Real Vision Live. For Real Vision, I'm Max Wiethe. I'm joined today by Matt Rowe of Headwaters Volatility Solutions, but today we're not exactly talking about that. You're kind of putting your credit hat back on, throwing back to the old days for you.
Yeah, I am. And I was spurred on by a comment that I read from Raoul about defaults and increase in defaults. And it really knocked me out of my chair to, want to raise my hand and say, I have something to say here, because this is where the intersection of volatility, credit, and equity come together. And it's something I'm passionate about. And I might be one of 10 people that really am. But, that's what I'd like to talk about today.
Well, wonderful. Yeah, I always love when this happens because we do have such a mix of an audience here. Some people are, retail investors, students trying to learn, but we also have people like yourself, professionals who keep up with our content. And it's always very inspiring when a piece sort of touches a nerve with both groups of people. When the up and coming people, the learners are like, I'm really learning a lot from this. And at the same time, you have a professional like yourself who says, you're onto something here. And I think that's kind of what we're going to talk about is you saw that piece from Raoul talking about insolvency and said, you're onto something here. But Raoul's a macro guy. He's trying to put all the pieces together, and we're really just going to examine that one piece of insolvency. So what is it that you saw from him that you thought, yes, he's really onto it here? And then what is it more that you think viewers need to understand?
Yeah, so at a high level, what I think is really important is, number one, I think he is onto something. And I think that the application of what he's onto is actually very important for all investors. And what we've experienced in the last decade is sort of moving further and further out on the risk tree and getting pushed by the Fed with monetary policy to take more risk and look for yield in ways that you might not have otherwise wanted to. And that's all a big part of the relative value framework. And that's what we do at Headwaters as a normal course of business. So the reason why it touches a nerve for me is because I see and have seen investors taking more and more and more risk in ways that I am concerned they're not fully appreciating, which is not to say that they don't know it. It's just a matter of there are nuances to it that I watch and have watched for 20 years that I think are important. And I've sometimes felt like, the guy on the outside of the room, like in The Graduate, banging on the wall, like, hey, somebody needs to pay attention to what's going on here. And that's kind of was my reaction to hearing Raoul's comment was, he's on to something. People should listen to this. And I'd like to chime in on why this is important. And so just at a high level, why it's important is that a lot of the world is dominated, a lot of the investment world is dominated by large players in the space. And the way that a lot of the quantitative efforts look for cheapness, if I can use air quotes on live broadcast, is to say, what's the distribution of stocks? And what we do, the way we look at volatility, if you've watched any of the other segments we've commented on, or, if anybody knows me, you think about volatility mainly from a distribution standpoint. What is it telling you about the potential for stocks to move up or down? And that's sort of the implied. And then realized volatility is what actually happened, right? So when you think about the potential distribution of stocks in a sort of elementary framework, they can go up or they can go down. But what causes them to go up or down? And how do you assign probabilities to each of those movements? And then as you propagate out on what would be...
Sorry for interrupting your video, but I have an important message to share. At Real Vision, we pride ourselves on providing the very best in-depth expert analysis available to help you understand the complex world of finance, business, and the global economy. So if you like what you see on Real Vision's YouTube channel, that is just the tip of an iceberg. You should come over to realvision.com and see how we are not leaving any stone unturned, from publishing more in-depth videos, live discussions, written reports, and our latest feature, The Exchange, where you get a chance to engage with experts and fellow subscribers and learn from everyone's experience. It is an experience which you live and you learn from. So if you go to the link in the description or go to realvision.com, it costs you just $1. I don't think you can afford to be without it.
Up or they can go down. But what causes them to go up or down? And how do you assign probabilities to each of those movements? And then as you propagate out on what would be referred to as a binomial tree, you start to get like, probabilistic determination of movement in stocks. But where the default comes in that I think is extremely important is that there's a concept called a trinomial tree, which is used in stochastic credit modeling and some other more high-level scientific estimations of credit spreads and equity pricing. But to speak about it in plain English, because I'm not a PhD, I always have to translate this stuff for myself from people who are smarter than I am. You really have to consider, what's the potential that this company fails, right? You've got the potential that it goes up, you have the potential that it goes down in an organized statistical fashion, and then there's the potential that it fails. And there is also other, events like a takeover or, things like that. But the big three are up node, down node, and jump to zero. A newfound form of cheapness in stocks for large quantitative firms over the last 10 years has increasingly and in different waves been high default risk stocks. Because if you say that a stock is intrinsically cheap by 20% because the market is overestimating its chance for failure, and you lop off that third node or assign it a probability of zero, all of a sudden it's cheap, right? So when we watch investor behavior in the market and we see how this plays out, there have been different waves where default high dividend stocks would perform very well on a relative basis, and then they sort of change their focus. I say they, like large institutional equity buying, changes the focus from buying or chasing dividend yield to all of a sudden accumulating and pushing up the relative performance of risky stocks or high default risk stocks. It's something that we observe on a daily basis. I've continually been frustrated that people aren't focused enough on this, and that's why this topic sort of knocked me off my chair as like, this is an opportunity to talk to a broader audience about why corporate insolvency default probability actually matters for equity investors.
Well, I think the clearest example of this is some of the ways that companies have declared bankruptcy and the stock has gone up because people are. It's essentially they're buying the news, or buying the rumor, or thinking that it's just a rumor. Like I don't know how to think about it. I mean, Hertz is one that comes to mind. Are there any good case studies of this from the past few months that you think perfectly exemplify this problem of the market just totally disregarding insolvency risk in its pricing of equities? And then I think we should talk as well about credit spreads and how that plays in too, because it starts there. It starts in the credit spreads and then it plays its way into the equities.
It does. And, it's a really confusing mix of components, and it's not the same, to your point of a couple of examples, it's not the same for every company. So for example, PG&E is a complicated situation where they've been on, the doorstep of bankruptcy or insolvency for years. But one of the most attractive assets that PG&E has is they have a huge pile of tax write-offs, of losses that whoever acquires them can use as a tax offset on an ongoing basis. So the equity is actually worth something because of the tax benefit of all of the losses they've accumulated. So you bring up a good point, which is that you can't paint with a broad brush across all scenarios. You have to sort of think about it, in idiosyncratic terms or in different buckets. So some of the very high profile insolvencies have strange nuances to them. I will say that from my personal experience, one situation that shattered the precedent for bankruptcy and the relative positioning of equity stakeholders versus credit stakeholders was General Motors, in 08, 09. So, the way things shake out now, it's a little bit different. Hertz, people's idea around Hertz is that Hertz is not going to go away. It's a valuable brand. They will survive. They will carry on. It's just a matter of who's going to take the markdown. And, are the equity stakeholders going to get wiped out and the bondholders get recovery, on the assets, and then they move forward with a reorganization, or will they bail out the equity stakeholders and the debt and move forward? That it's sort of it has a lot to do with the incentives of the current stakeholders of the company and who wants to come in and try to take control and reorganize the company. What I think is more important to broader equity universe or equity investors is, the stuff that's not big, high profile bankruptcies, things that are part of the high yield index. And what we look at, there are a number of factors that you can look at to observe this. But maybe the best one that everybody has access to is the Russell 2000, right? It's an index of 2,000 stocks that are relatively small cap. So if anybody wants to look at this at home on any service, you can spread the differential of performance between the Russell 2000 and say the S&P or the NASDAQ, and take a look at that. And the way that I describe it is that when people are looking to add risk to their equity portfolio, but not change the amount of risk they're taking in dollar terms, they will rotate out of the S&P and move into the NASDAQ or the Russell 2000. So you can see in periods of time when the high yield credit spread is tightening, you tend to see the Russell 2000 outperform the S&P just because people are sort of accepting more credit risk, right? So buying high yield bonds, at a relatively tighter spread or higher price is a signal of increasing confidence in those underlying companies. The same is true if you see outperformance or movement up in the underlying equities of the company. But this is where we get into the nuance of capital structure, right? Where when a company fails, traditionally speaking, the equity stakeholders get nothing, and the bondholders get the distributed recovery of the assets. In a post-General Motors world, that's not the way things always work. And we also see a lot of people chasing risky stocks or buying them as a new form of cheapness. And it makes me cringe to see that behavior happening blindly. And that's, again, one of those things that I want to raise my hand and say, back to a mantra that I've said here before is know your risk and get paid for it. Kind of works in the other direction too. Like if you don't know what your risk is, you can't really be sure that you're being compensated for it. And I see a lot of blind or accidental accumulation of risk that people might not fully appreciate. And a lot of it comes down to default. And I think if we do see a wave of defaults move through the market above the retail sector and some of the consumer discretionary stuff that we've already seen, I think there could be some nasty outcomes that people didn't predict.
So you talked about GM and it being a post-GM world.
Yeah.
I guess, is the market acting as if everything is GM, that everything is too big to wipe out? And that's the misperception that they're having, is that they're taking that GM sort of case study and applying it to every single equity, regardless of its systematic importance.
Yeah, that's a good point. And I think that there is some bid or some appetite for distressed equities because there's money to go after those type of strategies. So if you run an asset management firm that specializes in distressed situations or workouts, there's not a whole lot of stuff to do. It's relatively small in number, but it's going to be greater, and we've seen more people raising money for that. So what you need to do to get control of a situation there is you either need to establish a position on the credit side of the scenario, or you need to establish a position as a equity stakeholder in the company to sort of start to vocalize your opinion about how the reorganization is going to work. So there's some confusion about how DIP financing works and who's in control in a bankruptcy. But again, what we see is just sort of like a accidental accumulation of credit risk in stocks. And I know that may sound a little bit confusing, or it may sound a little counterintuitive, but from our seat, we see it happen, relatively frequently. And, in the smaller scale names, the less high profile names, the non-PG&E, the non-Hertz type situations, equity stakeholders, generally speaking, don't do well in bankruptcy.
Okay. So I guess, in my perception of the market, there are some companies that their equity price is more acutely driven by the credit risk. Like Apple I would say that daily movements in the price of Apple are probably not highly correlated with movements in their credit spreads, which I doubt are moving very much. So at what point does the equity price start to really, really be correlated with what the credit is doing? And what should you be looking for to determine if it's acting funny?
Yes. So the question you just posed is the holy grail of capital structure arbitrage, and there are a lot of people and many papers written on the topic of stochastic credit analysis and things of that nature. But roughly speaking, from a sort of classical standpoint, equity is a call option on the assets of a company above the debt holder's valuation. So if a company has 400 million of debt and the assets of the company are 600 million, then recovery for the debt is par or 100%, and the equity stakeholders own a call option on the residual assets. Other people would argue that it's slightly different or that the formula should be more elegant than that, but that's a rough back of the envelope calculation. So when you start to get a market capitalization that erodes to a point where let's say that the market cap of a company drops to 250 million, but they owe 400 million in debt. Now, some of it has to do with how near term is that debt, and some of it has to do with the seniority of the claim, and some of it has to do with the nature of the business, right? Some companies are just in sectors are more highly levered by nature. So, biotech companies, for example, tend to be relatively low market cap, high debt. They're levering up to spend the money on trials and research, and if they get it right, it's a exponential return. And if they don't, then there are a couple of different outcomes. But the question you asked is a very important one. And as market caps drop below the sort of the value of the debt, then you start to get into what in sort of academic terms they'd refer to as the zone of insolvency. And so that's where you have to start worrying about it. We're not necessarily there yet from a market standpoint, but we're certainly at a point where if you increase the implied default rates in high yield, if you actually take up the actual defaults that we experience in the high yield market, then this is going to become front page news and something that people are going to be studying up on very quickly. So that your question is the question, in my opinion, for the next 12 months.
All right. So, market caps, I guess you should be watching them relative to debt levels creeping down. And as we get closer and closer to that even level, that would be an indicator that this insolvency phase is coming. Yeah. Up to this point, we've really focused on what you would consider to be taking undue risk in people buying these equities, basically, pricing the default risk at zero. But we have a question from MKS in the audience who says, I've recently been looking at puts for betting on insolvency results. And he's finding that you can get like 5 to 10x returns in terms of insolvency bets. And he says he's looking at GM, Ford, SPG, and airlines. Okay. Is that a reasonable type of return structure for the likelihood of a default? If somebody is trying to bet on these defaults using puts on equities, what type of payout ratio should people be looking for to feel comfortable with a bet like that?
Yeah, so that's a very sophisticated question and could warrant a long conversation. But I would say, generally speaking, the first thing that comes to mind is that you have to be careful on your timing, right? Because if you get everything else right and you understand the fundamentals of the situation perfectly, and you buy December puts against any one of those names, and then the insolvency happens in February, you have a problem on your hands because you've spent premium to bet on a scenario that doesn't play out in your time frame. So I think you have to be careful about your assumptions around timing. Being short credit has been and is an expensive trade. One of the reasons why more people don't do it is because the cost of carrying the positions to bet against things is expensive. And it's the borrow rate, it's having to pay the yield on credit if you're taking a short position. And so you just have to be careful on timing. I would ask a lot of questions around your timing, and I would avoid precise determinations around insolvency because there's nothing precise about it. And I've seen so many situations working through these scenarios where it seems obvious that this is going to happen by March, but it drags out until September, or you get a surprise announcement that happens sooner than you thought. So just be careful on timing. As far as the payoff goes, I mean, I think you have to look at things within the specific situation of where the incentives are aligned. And one of the reasons why General Motors became sort of a poster child for this type of situation is because the retirement system of General Motors was almost entirely invested in GM stock. So if you let GM stock go to zero, you're going to wipe out the retirement. So one of the reasons why they threw out 100 plus years of bankruptcy precedent in the GM situation is because they would have wiped out 250,000 pensioners, and that wasn't a palatable result. So they basically bailed out the equity when they bailed out the credit, and a lot of credit holders were like, wait, you can't do that. And they said, here we go. So that's, you kind of have to know who's involved on which side of the balance sheet, the equity and the credit side of the balance sheet. Be careful about timing. And as far as payoffs go, you have to, that's where you need to get into the weeds on recovery a little bit, right? Because with a company, sometimes it's in everybody's interest to not let the equity go to zero and to bail out the company and let them carry on as a existing and functioning company in order to not scuttle the business model. And so there are other incentives that can be in play. So I would avoid just broad strokes on, a payoff ratio that works for every situation. You kind of have to get your hands dirty on each one to make sure you're positioned right. But probably the biggest one is just be careful of timing.
Okay. And I just wanted to clarify, these are puts on equity, I think.
Yeah.
MKS.
So I think the be careful on timing because, the debt holders, when you get into a distressed situation, the debt holders are really driving the discussions. And if they're long credit, don't forget that they're earning a lot of money while they wait, right? Because if you get to a situation in a distressed credit scenario where the yield is 10, 12%, even if it's accruing, monies paid that need to be paid, it strengthens their position, and they're in, their incentives are different than the equity stakeholders. So if they have the ability to change the timeline to sort of affect different outcomes, you just have to be aware of that. From a payoff profile standpoint, I think just shooting from the hip here, my compliance is probably going to, give me a tap, but I would say that 5-1 is like for a payoff for equity puts on an insolvency is a little bit low. I would expect just intuitively, if you are looking to bet on the potential failure of a company and take a position in equity puts, that you should be seeking something north of 5-1.
Okay. All right. And then I guess that brings up a question about, you talk about timing, taking very, very short dated puts where the premium is much cheaper and rolling the position versus paying out for duration. Somebody is betting on insolvency. Is there any historical evidence as to which one is the better way to go if you're looking to basically have if you're not sure how long it's going to take? Should you go way out in duration or should you be rolling these very, very cheap puts with low probability?
Yeah. So sometimes the market answers that for you. And what I mean by that is that in these distressed situations, oftentimes the offer on down and out puts is non-existent, or it's so expensive that you wouldn't consider it. And the things that come into play there are a number of them. When you get into a distressed situation, the stock loan on these names or the cost of carrying a short position starts to get very expensive. And there's sort of a parity that happens between the securities lending rate and the high yield spread for that specific situation. So if you can earn 15% by being long credit, and you could maintain an equity short position and carry that at, say, just 1%, generically speaking, that seems like there's a little bit of a mispricing in that situation. Now, there are nuances to every situation that can account for that sort of stuff. But I guess my point is that short dated puts tend to be more of the name of the game for, betting on insolvency, because it's super expensive to carry long dated puts. when things get truly distressed. If you can get positioned ahead of them getting truly distressed, you can benefit from that, right? So let's say that you're ahead of the curve and you've done all the research on a company that you're certain is going to fail, or is going to run into credit trouble, or you want to bet against it one way or another. By taking a longer term position in the puts, you can benefit a couple of different ways. You can have directional downside exposure. You can also have beneficial exposure to the stock loan rate going higher as the situation erodes. So it kind of depends on your entry point. If you're ahead of everybody else, then probably a better idea to look further out on the curve. If you're sort of diving into an active situation, just be careful of the long dated stuff, because it prices in a lot of other funky things like borrow rate and recovery and things like that.
Okay. We actually have had on somebody in the past who is a credit investor who, for the reasons you said, doesn't like to get short credit and does that sort of holding the credit and gets short equity puts. I would recommend anybody, Dan Zwirn. If you just search Dan Zwirn, you'll find the piece. I can't remember the name of his firm. I think it's Arena Investors. So I would recommend that to all of our viewers and maybe to you as well, Matt, to check that one out.
Yeah, definitely.
But I do want to get through some other questions that we got. This one I think is a really good one to sort of broaden the conversation. Srini wants to know what sectors are most leveraged and at risk of default. And I'm going to expand that question to say, what does default risk look like to you, and where do you start looking?
Yeah, so that's okay. That's a great question, and it actually works into something that you mentioned earlier, which was in the question from, was it MKAS, I think?
MKS, I am sure that's a 3 letters acronym.
You mentioned airlines. So I think airlines are a specifically challenged business model right now in this current environment, right? Revenues are down, cost of operations have stayed relatively static. They have a serious problem, but they're also on the top of the list of companies that rightfully should be asking for some sort of government assistance. And every time the conversation of airline insolvency comes up, people in the credit world will chime in and say it's a revolving door, right? Like if you know history, airlines are a revolving door of bankruptcy or reorganization or restructuring, and people will frequently point to Amtrak as well as an example of, well, look, if things get bad enough, the government took over Amtrak at one point because it is the mainline service for the Northeast. The economy can't function without airlines, so we need it's a systematically important or systemically important function. So be careful applying broader assumptions of bankruptcy and insolvency to airlines, because there are forces at play that cause things to happen in ways that only make sense to airlines. So as far as what sector is most at risk, I think small cap consumer discretionary that is competing with Amazon, Walmart, Target is probably at the top of the list of things that I would say intuitively. Retail, of course, especially retail that requires foot traffic and relatively small footprint. It's hard to watch the struggle of small businesses against the likes of Amazon, Walmart, and Target, because they can't adapt and do online delivery or online shopping, ship to home, pick up in the parking lot, all of these different flexibilities that the larger companies can display and can give to customers. So I think personally, it's sort of hard to watch smaller businesses fail because they can't compete with that. But from an investment standpoint, that's the reality, right? So if the world is moving forward in a more careful fashion from a physical interaction standpoint, I think that's a big consideration. Also, the economy without some form of fiscal stimulus that has a meaningful push to it, Powell has been very straightforward about this. Most people, without being partisan about this, would agree that without stimulus, the economy is worse off than the stock market is pricing right now. The stock market's pricing in some probability, in some number for stimulus. So if we don't get some follow through there, that could be a catalyst for more defaults and more bankruptcies. So, I think discretionary spending, retail, things like home builders have been doing really, really well. But don't forget the cost of lumber, right? Like if you're watching home builders and say, well, there's this huge amount of demand for new homes and prices are going up, the lumber futures in the last 3 months, if I remember correctly, I don't want to pull it up right now, but I think they've more than doubled. So the cost of building a house has gone up considerably. So you just have to kind of get your hands dirty on it. But I'd say retail and consumer discretionary.
Okay, that was all very qualitative, very much looking at the economy. Is there maybe a more quantitative, like a screen you could run where you go through something looking at, debt outstanding, how soon is the debt coming? Like, should you be worried about insolvency for a company that doesn't have debt due in the next 18 months? Yeah,
well, that's a important consideration. So when thinking about stochastic credit analysis, or basically looking at the equity and the equity and the credit of a company, the old VAR model is one where you're sort of trying to take the volatility of an equity as an indicator of risk. So you're sort of watching investors' behavior or skittishness and using that as a proxy for the risk factor of a stock. So as you see a stock reverberating around, if it's moving around in a tight channel and then all of a sudden it starts to swing wildly, you are theoretically increasing the probability of default. So what I would watch is a couple of things. If you want to screen for high default risk stocks or, names where the default probability is increasing, you can watch for if you can calculate and observe the credit spread of the capital structure, that's one. And if it's widening, that's a worsening situation. If the volatility of the underlying equity is increasing while the credit spread is widening, that's also a secondary indicator that the situation is getting more precarious. If you have short-term debt that's coming into focus, so I would say inside of 2 years, debt holders start engaging with management to renegotiate or restructure or ask for what's the plan to pay us off when maturity shows up. And so a company where puts are super expensive, the credit spread is wide, the volatility of the underlying equity is high, and they have short dated debt, like that's a very, very precarious situation. So if you want to screen for, names and you were using those 4 components, I think that's probably a good place to start for a quantitative screen.
Okay. And then Srini had another question, which is there a way to find out the debt ladder of a company?
Mm-hmm. There is. It depends on the data service that you sign up for, but in various systems, Bloomberg, Reuters, whatever you use, and there are plenty of places to get this in a free form too. But you're basically looking for the whole capital structure, right? So I use Bloomberg, and this isn't a promotion for Bloomberg, but like in Bloomberg you can do DDIS, David Indigo Sam, and that shows you the distribution of the debt. And so I don't want to turn away from the group, but it'll show you a bar chart and say, there's a term loan that's due, there's an unsecured debenture that's due, and show it to you on a timeline. So that's one way to look at it. You can look at company filings though directly and see the debt and the maturity of the debt, but it takes a bit of reading to get through.
Yeah. Okay. So I have a couple of other questions here. Let's see. Bernard wants to know, based on your experience, what is the pivotal point when a company realizes they will do nothing but burn cash and pivot towards servicing their debt and close business? Does that ever really happen? Or do they, put their heart and soul into this? He says here, they put their heart and soul to this and it's hard to say goodbye. So do companies hold on longer than they should? And does that provide an opportunity?
Yeah, it does. And that's a great observation. So when distressed situations are becoming distressed, there's sort of an interaction between the debt holders and the equity holders. And at some point, from a legal precedent standpoint, the management of the company's responsibility shifts from maximizing shareholder value to defending the value of the assets that are due to the bondholders in a recovery. And it's a non-specific sort of amorphous line that's referred to as the zone of insolvency. So if a company, if Bernard was a bondholder in a company, and the company was having a rough time, the stock price was dropping, its business prospects were falling, and Bernard would say to the CEO and the CFO, hey, look, I think you have entered into the zone of insolvency, and your responsibility is now to me and other bondholders to preserve and defend the assets of the company because the probability of default is high enough that that's warranted. So in a lot of cases, there's a non-specific conversation that happens between debt holders and the management of the company. Most often, management of companies is incentivized by stock options or some sort of alignment of return on the equity side. So they tend to be, operate and predisposed to behaving that way. But it's not always the case, and it's not the same for everyone. But anybody who is a bondholder or is thinking about getting involved as an investor on the debt side of the situation should know that becomes part of their rights in the negotiation, is that you can give the management a nudge and say, like, hey, you can't be paying out a 7% dividend to equity stakeholders when the next coupon payment's in question, right? Like, it's an extreme example, but that's the type of stuff that that gets shut down.
Would you say that is, going towards qualitative screens here? Is that something, maybe a management that is extremely incentivized to play ball with equity holders and also has some of those quantitative factors, maybe gives you a better chance of finding, going back to MKS, like a disproportionate payout ratio because they're so focused on this other side?
Yeah. I would say yes. In most cases, there's it really depends on who's involved in the situation, and the debt holders have a lot of tools at their disposal once it becomes more officially announced that the debt holders are engaged to either, if there's a 2-year maturity and they're saying, hey, let's do a debt for debt swap, we'll swap 2-year bonds for 5-year bonds, but these need to be the terms, right? It gets more expensive for the company. And then the management of the company needs to then turn around to the equity stakeholders and say, hey, we're gonna restructure the debt. And they say, well, we don't like those terms. And they have to stand up to the equity stakeholders and say, it's what we need to do to survive, or, we don't have any other options, or we could, companies are always looking at this and saying, well, the ultimate would be a management team saying to the equity stakeholders, you don't want us to raise debt, that's fine. So why don't we do another equity round, at the current prices, there you go, you can vote with your wallet. So it becomes a bit of a tug of war that's more high profile than the normal state. And that's the thing that drives me nuts about the last, 2017 was a perfect example. The mantra in 2017 was buy anything you can get your hands on and lever it up. Didn't matter what it was. If it had a 1% chance of defaulting, like, it's 1%, too cheap, right? So people were hoovering up risk and levering it up in a grind higher. And now that we're seeing more of an emergence of relative value strategies and people contemplating default probability and like the potential for this type of situation, like, we're now back into more of a relative value long short framework where people are feeling encouraged about being able to bet on winners and bet against losers, whereas the last few years, 2017 was just buy everything. 2018 and 19 were more like, well, be long only, but just be careful about what you're long. And 2020 has changed to, not only be careful about what you're long, but maybe it's a good idea to layer in some hedge or, short alpha, because not everybody's going to make it.
Okay. Well, we got a question in from D-Rock about the VIX. I'm just going to let D-Rock know that I'm just saving that for the end. We're going to get through these credit questions, and then we can talk VIX.
Cool. Always good to get a question from somebody named D-Rock too, by the way.
I know, right? Especially, when did you ever think in your life somebody named D-Rock would be asking you about the term structure of the VIX?
Yeah, that's right. I love it.
Yeah. So, but we did get a question from Russell that says, would you agree that if we don't get stimulus, we're all GM shareholders?
Yeah. Yes. And that's yeah, I mean, so there, yes, the short answer is yes. And I think that there are variations of that. You can think about the way Japan is, and you can take some pretty extreme, examples, or like think about this in looking forward in a couple of extreme ways, where if the government, the Fed is currently buying high yield bond or fallen angel credit, right? And if one of the reasons why I find it concerning that the high yield names and the super distressed stuff started rallying on the Fed buying high yield in May was because it's just a propagation or an extension of that idea that they're actually buying credit. So the thought is, or what's implied in the market is, well, if they're buying this now, if they're buying fallen angel credit now, if things get worse, they're going to go further out on the curve. And what if they start buying the debt of all companies in the U.S.? Then if it ends up being the case that the government bails out every company, and we as citizens are all shareholders of the one holding company of everything, then what, right? Like that starts to get kind of confusing. But I think, yeah, the short answer is
that's
yes.
what you see with the Japanese stock market. Like they are basically they own their own stock market, and
they do.
We can see what the returns are long term for when that happens.
Yeah.
Well, I guess that kind of opens up the table to assuming that Raoul is right and you are right about some of these risks and everything comes to fruition. What is it going to look like in a broader sense for the market? Where are how is it going to play out? We can talk about step by step. We can say this is how it'll start, this is how it will end. But what is a true insolvency phase going to look like?
Yeah, I think so. The challenge, right? Like, to come back to General Motors again for a second, right? General Motors had to bail out their equity because either these 250,000 pensioners were going to lose their benefits and the government was going to have to take care of them anyway, or they could prop up the company and they could carry on, and the VEBA wasn't going to get wiped out and they could service their pensioners independently. So I think it was sort of viewed as either way the government's paying for it, or either way, like the system needs to support these people. So we just need to figure out the most efficient way to do that. And I do think we're sort of facing a system-wide General Motors moment where we have high unemployment, right? Like we have a lot of people who have lost their job, and we have a lot of people who will lose their job if defaults increase. And so what do you do? Do you prop up the companies that would otherwise be employing these people, or does the government just give direct benefit in the form of unemployment benefits or other to the people who are out of work? And so it does become a system-wide problem. But I think there's a tug of war that goes on between the Fed saying, well, we can't buy bonds of companies that we know are going to fail. We can't knowingly go into a situation and lose money. That's sort of the limit for them of what they can and can't do. And I think the fiscal stimulus portion, the U.S. economy, roughly speaking, is about 24 trillion in GDP. And the idea in March, when we were facing an economy shutdown due to COVID, was, well, stimulus can do some form of replacing GDP destruction that's a result of the pandemic. And so in rough numbers, you can think about, all right, if we're replacing 25% or 1/4's worth of GDP, we're looking at $6 trillion, right? Just to put these numbers in perspective, when Pelosi and Mnuchin are talking about back and forth about these things. So yeah, I think the government is, you can look at it in a couple of different ways, but they're effectively replacing GDP destruction. And where do we come out on the other side of the pandemic? Like, are we a different economy? Do we revert back to an economy that newly embraces mom and pop stores and hugging people and shaking hands? Like, it kind of depends on what the social response is to the pandemic and how people want and feel comfortable doing business going forward. But it doesn't seem reasonable to think that we're going to bounce back to the way things were in Christmas of 2019 as far as the comfort level of interacting and the way we shop and the way we sort of do business. So.
Well, I think really interestingly is going back to that GM period, there was no precedent for stimulus, for checks going directly to people for unemployment. And arguably there was political backlash to the bailouts of these companies, to bailing out the banks. And if you look, there seems to be at least, there seems to be some appetite out there in the public for stimulus, and there does seem as well to be some pushback against bailouts. And so now that the politicians, it might not be the most efficient way. Like they might have looked at the situation at GM and determined that doing the bailout and having them, keep their pensioners afloat themselves was the best way to do it. But in some senses, there's a political aspect to it where it's not even really about what is the most efficient way to replace this GDP, but it's also what's the most politically palatable way. And there has been major changes in what can be done. And so that might be, in my mind, that's one of the reasons why I think that there is greater insolvency risk going now than looking back, is because there is a mechanism, there is a policy mechanism to help those people out who are hurt most by the insolvency that doesn't involve what politically is viewed as corporate welfare. Yeah.
And that's, I mean, in most cases within the business realm, I try to be apolitical or try to, make factual statements as opposed to, making a political one. But
I'm just trying this is more game theory of like how. I'm not saying like this is what I think.
I wasn't tagging you with doing that. I'm more like caveating my response that I'm about to give right now. There is a lot of discussion around who is actually fiscally conservative, right? The part of the partisan dialogue is, who owns the pedestal of fiscal conservatism, and what does that mean? And is it actually, like, when it's all said and done, like, what's the side that they would take on this sort of stuff, right? So I think you're right. I mean, we started to hear the concept of helicopter money during 08, 09, right? Like the checks that were just going out to people, but that was new. That was something that people were sort of like, oh, that's a good idea. Like that'll bridge the gap a little bit. And like they called it helicopter money because they didn't have any other term for it, right? They didn't even use the term stimulus at that point, or at least it wasn't sort of widely discussed. And we've also had, commentary from the ECB and from Draghi on, concepts that sort of rattle people's way of thinking, like whatever it takes, right? Like that's something that resonated with everybody in the investment world. Like, wow, does he really mean that? Is the ECB really going to be prepared to do whatever it takes to avoid, further meltdown or to support the economic growth? Those are the types of statements that, people who are trading put skew need to be very, very, very acutely attuned to, because, if the Fed is like this comes back to the big debate that we've talked about before, like what's the strike of the Fed put, right? Like how far would they let the equity market fall before they stepped in and started buying stocks? And, there's no answer, but some people sell puts because they figure, well, look, if I sell a 500 strike put on the S&P and I end up losing money on that, like I got a lot bigger problems and so does everybody else than like whatever money I just lost on that trade. So there's some idea that if you go far enough out in the tails that it doesn't really matter. But
it's why I don't buy the need to have physical. Like if I need to get my hands on my gold, like I'd rather have guns or food or
right.
like so many other things. So that's why I'm not like, I'm fine with GLD. I'm fine with it.
Yeah, no, I think like if you have to take physical possession of something for that same utility, I would say I'm with you. I'd rather have, 10 pair of running shoes, like shrink wrapped in my closet than an ounce of gold, right? Because like number one, it's already divided into 10 pieces. So if I needed to trade it for something, I have something and I can put them on my feet and I can run faster than the next guy. So, I would agree with that. But I think the question of, aren't we all like, isn't the whole system kind of like GM? That's exactly the way I think about it. I think, if you go far and if you push the system far enough, like they're going to have to figure out a way, we as a population are going to have to figure out a way to sort of take care of ourselves, right? Like it switches from watching the politicians do whatever they're going to do and try to make policy and argue one way or another to like, how are we actually going to function, right? Like, and I think that at some point, Japan's a great example because the citizens basically do own the equity market there, right? And you can see how it's performed. You can see what's happened to interest rates. You can see what happened to credit spreads. There are precedents for this in the U.S. too, right? Like they take the state of Alaska. If you live in the state of Alaska, you do or did, or I'm not sure the current state of it, but you get a dividend because you live there, because there's business function that's generating profits where they feel the need to redistribute it back to the citizens. And so it's just going to, we're going to have to see where we go. But I think part of this is that without a real recovery in the economy, without a real return to business activity and risk taking that we've seen before on the small business level, we're going to need stimulus. And without stimulus, we do have, without taking sides politically, the stock market is currently priced for stimulus. If they came out today and said there will be no stimulus ever going forward, as a statement from both sides, I think the stock market would probably drop 15%. So, I think it's fair to say that it's priced in. It's just a matter of to what degree.
Okay. Well, we have 3 questions. One of them being that vol question for the end. I'd like to get through these and then we can wrap it up. But before we get to D-Rock's question, we got 2 more questions from MKS and Russell. We'll start with MKS. So if the government does take all the assets of the zombie companies they bought into, did they just sell those assets for the cheap to those in the know? He says he's worried about further income inequality. So what happens after they buy the assets? What are they going to do with them all?
Well, I guess it sort of depends on how they would do it. So let's just say hypothetically through the mechanism that's available to them now, let's say that there's a company that's, a fallen angel credit, which just to be clear, that's an investment grade company that's being relegated to high yield, right? It's not a really high default risk type name, but it's something that's eroding, right? Let's just take an example like that goes from IG to high yield, and then it quickly slips into distressed territory. So let's say that the Fed were to have bought bonds in this company as it's sort of sliding, and then it gets to a point of insolvency. Number one, I don't know what the policy is for the Fed if they get to a high default probability situation. They might end up actually technically and legally be a forced seller.
Because they have to own high quality assets.
Right. So that's a waterfall scenario that we've actually talked about that I don't know if anybody knows what the mechanism is for that. And
it's never happened.
Yeah. So you have that potential. But if they did end up being a bondholder and owning it all the way into insolvency, then technically they would become the receiver of the recovery that the company gives. And most often the assets are liquidated and then the recovery is delivered to bondholders in the form of dollars, not in physical assets. So the people who benefit from inefficient liquidation of assets in bankruptcies wouldn't always be the bondholder, I guess, if that makes sense. So, I think it's part of the reason why you see a lot of hedge funds out there right now gathering money for relative value and distressed credit plays. And some news stories have said, there aren't that many distressed credit opportunities. Why are people gathering money to invest in distressed credit? And they put up their finger and they say, there aren't now, but there will be, right? So that's sort of to Raoul's point and why I'm spurred to say something is it seems pretty clear that if things keep going the way that they are, that we will see an increase in implied and actual defaults. And that's where that sort of strategy kicks in.
So you're almost talking like the second derivative of, so there's the distressed people who are going in, who are buying the bonds while they're cheap and they're getting the recovery. And then there's another group of people who are buying the assets that are being sold to make that recovery, and they're getting a deal too.
Yeah. Yeah. So, that's, if
that
I
might
think
be someone who's an operator or a real estate investor, or they usually have a specialty as to why they want to buy that asset.
That's right. And, if you think back to 08, 09, you had bonds on companies with real tangible assets trading below recovery value because people lost their ability to fund those trades, right? So that was an opportunity to make a distressed purchase of good assets without actually having to go through a default cycle. What seems to be the next wave is that people aren't lining up to necessarily do that. I think it's more a matter of, will we see an increase in implied and actual defaults, and then what happens to it? But in a world where the 30-year is yielding 1.4%, right? People's incentives to take risk are a lot different. If you can get 7-8% on credit, the high yield index I think is yielding 350 over, something like that, 345. from memory, which means that you're actually yielding 3.45 over the 5 years. So that's going to be 3.7%. That's not a whole lot of return, right? You can make or lose that in one day in the NASDAQ. So it's, there's a weird relative value dynamic that's in play that creates a lot of good opportunities for people like us, but it also, it's something that people need to be aware of, on the equity side of it.
Okay. And then the final question related to this is, if the government does end up stepping in and protecting these companies that are defaulting and bailing everyone out, is that an inflationary impulse? And if so, what are your thoughts on gold?
Well, is it an inflationary impulse? Maybe more stagflationary, I guess, would be my reaction, because if we're in a situation where the government needs to be taking that type of action, then they might be inflating the assets without any growth, right? So we may actually be in an economic cycle of contraction or stagnation, but the assets are getting pushed up, right? So we kind of see that. In my opinion, we've been seeing some semblance of that with house prices and lumber prices moving up the way that they have, partly spurred by the migration out of cities and into suburban areas, but also, with gold, silver, other, the equity market, particularly large cap tech. You see evidence of inflation of risk assets, and at the same time, you see stagnation in economic activity. So I'm surprised that word doesn't come up more, honestly. But I think it's more driving a wedge between asset prices and risk, I guess. And in between that wedge is where stimulus fits, right? So as in my opinion, the way I think about it graphically in my head is that you get this elevation of risk asset pricing in houses and stocks and gold and silver, things like that. And it's become decoupled from independent economic productivity. And the wedge that supports that differential is stimulus.
Okay. All right. So that gets us through our credit questions. We have a couple of Vault guys who are taking advantage of your appearance today
Sure.
to get their questions in, and I feel we owe them a little something.
Sure.
So one question from D-Rock and then one from Christopher, and we'll close it out there. So D-Rock wants to know, what do you make of the spike in the VIX term structure in November, supposedly because of the election? Is this mispriced, and is this already priced into the equity market?
So the last part, I don't know. The last part of it, I don't think it's already priced into the equity market. I do think that there's a little bit of from a probabilistic distribution standpoint, it seems to me that the potential for the market to go up versus down looks like the odds are sort of off. I think the downside tail doesn't seem like it's priced into the equity market in the same way that it's being priced into the VIX curve and put skew, for example. So last question first. The first part, why is the curve moved from October to November? I think it's something that I actually just gave a comment about in Barron's a couple of days ago, where it's no secret that the election's not going to be decided on the night of election day, and that there's a plan from both sides. They're both preparing for a long, drawn-out transfer, right? And some might point to comments from the administration that there will be no transfer, that there's going to be a continuation. That type of commentary is why risk is getting priced out past the election and into November. So I don't think that we're going to see a smooth transition no matter what. I think the equity market is reasonably concerned about what that means, and that's why you're seeing it. Also, don't forget the agency effect of all of this, right? You have big investors around the world that are managing multi-generational wealth or retirement systems that are 100-year type things, but most of the risk takers, most of the people who are incentivized to take risk, get paid on a rolling annual compensation scheme. If you've bounced back and you're having a relatively decent year this year, you don't want to give that back by being long into the election and getting wiped out, right? Like your annual bonus is going to go away. So there's some behavioral component to protecting annual gains that goes into pricing year-end put skew that, can't be discounted. But right now, we're in uncharted territory in a lot of different ways. So I'm just guessing like everybody else. And that's my best guess.
Okay. All right. Final question is more generic and actually more about your long vol strategy.
Sure.
So Christopher wants to know, if we're aiming to profit on long vol strategies like straddle, should we focus getting the timing right more on the implied vol versus historic vol, or should we focus more on dealer gamma to see when the gamma flip will happen?
Well, that's a tough one. Number one, because you can never get a perfect number on dealer gamma. There are lots of different estimations, and people put out different opinions or aggregations of what it is. But I've seen very creditworthy groups come up with numbers for different time periods that are off by 5 times, right, in either direction. And so be careful where you get that information from, because nobody agrees on it all the time. The other one is that I'd say most, from a transaction cost standpoint and from a liquidity standpoint, most of the activity is sort of in the front end of the curve, and that's like 3 months and in. And that is because of a couple of things. One, the VIX traders and VIX arbitrageurs and relative value players are looking at like the front 2.5 months for the active VIX contract, and then for the roll. And the most common reset or event in the market is earnings, which of course happens once a quarter. So there's more activity in the quarterly stuff. The bid ask tends to be tighter. And you've got more gamma to them. Long dated options are very Vega driven, right? They make and lose money by the ebb and flow of implied volatility. The gamma characteristics of longer dated options are more muted. The gamma of short dated options is explosive, and the Vega is less important. So, if you're playing for a move, you want to be more geared towards the front end. If you're playing for an increase in implied volatility, you're going to benefit more from being longer dated, relatively speaking. But I would just be very careful of the longer dated stuff. Sometimes the bid ask and the liquidity is so nasty that you can eat up a big chunk of your potential return by crossing too big of a spread. So if you want Vega trades, like you want to make money when implied vol pops or drops, longer dated stuff. If you want like explosive gamma, the shorter dated stuff is better.
Okay. Well, Matt, thank you so much for doing this. It was a lot of fun.
Sure.
It was great to get a different perspective on the potential for insolvency. Please don't hesitate. If anything we ever have on inspires you again, please reach out.
I'll raise my hand. I'll be the kid jumping around with my hands waving around. But I would say in closing too, for anybody who's interested in this topic, you can look at the pricing of credit protection against puts on any single name that you want, and you can sort of back into, if you're involved in a situation or you're interested in looking at a situation, take a look at single name CDS or like the credit spread of that particular company, and you can price it against the puts, and you can actually glean some pretty interesting implied information there. Specifically, like what's the implied recovery rate? If you think a company is going to fail in the next month, and you think the recovery is 30 cents on the dollar for the bonds, you can do the math on both sides of the equation and see where you come out. And sometimes you can, sometimes you can, if a situation well enough, you can get long the credit with a specific and known recovery, own puts on the company, and you can actually pair the two together and make money in an insolvency. So it's, this is where it starts to get really interesting for distressed people.
Wonderful. Well, I know that might be, we say playing above the rim for everybody, for a lot of people. But I really enjoy, doing this, getting to see how somebody who lives above the rim gets to think about this stuff. So lots of fun, Matt, and have a great weekend. Talk to you again soon.
All right, great. Thanks.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.